Good evening, Chanaka sir.
Good evening.
Give me a few minutes to introduce you, sir.
Okay.
Good evening, everyone. Today's resource person is Mr. Chanaka Veerasekara, one of the senior lecturer from the Department of Accounting and Finance, the Faculty of Management Studies. Sir, over to you, sir. Thank you.
Right. Thank you, Naduni. And first of all, I am very sorry about the fact that I got delay. That is actually not my mistake because there was a power cut going on in our area. So I'm very sorry for that. Uh, so I hope everybody can hear me properly.
Yes,
Uh,
sir, we can hear you.
right. Okay. So Naduni, you have started recording, right?
Yes, sir. Yes, sir.
From my end, I am not going to record it. Okay.
Okay, sir.
Right. So once again, thank you very much. And so today, I hope all of you have gone through some of the uh, areas that you where you have some sort of understanding about how we record data when it comes to the financial matters in of an organization. So uh, I think probably you might sometimes all of you may have some idea about how we are going to record, how we are going to summarize, and how we are going to classify and report all the financial transaction as well as the events that take place in an organization. Right. So I hope Mr. Asanka might have gone through some of the basics, fundamentals of accounting, so that now at the moment you have some sort of idea about what exactly is accounting as a system is, and what sort of a outcome that we can get out of accounting system. So may I ask you a question uh, at the very beginning of our session? Can you please give me some answers if you are in a position that you can answer? So what should be the outcome of a process of accounting? So I hope that you all have gone through accounting process, and what should be the outcome of that? Any
Financial tracking and the profit output.
yeah, that is yeah, of course. That is basically output of an organization. I'm asking, like, now if you take accounting as a process, yeah, what should be the outcome of that process? So in the chat, I got one answer, that is financial statements. Yeah, that is the correct answer. So if you are looking at the process of accounting, so what we are really want to find out the set of financial statements. So what you said was correct. So out of the financial statements, we are interested about basically several aspects, right? Several aspects. As now we are going to dig into that matter today, how we are supposed to understand financial statements. Sometimes Asanka might have mentioned during last sessions, accounting has been known to us as actually a language. So what a language normally does is actually it makes us easy to understand things communicated by some other people or maybe some other entity. So that is the purpose of the language. But accounting also serves as a language when it comes to the businesses. Accounting makes us sort of enable to read what is going on with the business in terms of its profitability, its financial position, and its cash position, and as well as its position when it comes to the ownership as well as the debt. So basically, what we get out of the financial statement is actually a a sign, an indication out of how the company has done during the past year. If you take a financial statement per year, that basically the performance of the organization in terms of the profit and how good are they in terms of financials like assets and liabilities. So that is what we normally get out of the financial statement. So let me just share today's presentations to you. So probably we will be able to discuss through it. So if you have any questions, anything that you want to ask, please feel free to disturb me at whatever the time you want. I will explain anything you want. So, before we move into this area, I want to mention that this is actually a very basic subject. So we will be discussing very basic things here. So if you probably some of you might have already gone through all those things, probably you might have a better understanding of these concepts that we discuss here. Sometimes it may be a repetitive for you, but please let me explain all those things to the people who are new to these areas, right? So let me first share my screen. Right. So today's topic is actually the course is basically fundamentals of accounting. So today we are going to discuss about financial statements and financial statement analysis. So that is what we want to discuss today. So before moving to the topic, I want to tell you, like, you need to have some sort of understanding of accounting system before moving to this area. So that's what we have already done during the previous two sessions. So probably it would be the great time for us to move into this area, right? So right. So as I mentioned, if you think about financial statements, we can categorize those financial statements in different ways, but most common categorization is this. So we have basically four statements that we normally prepare. First one is actually known as income statement. The income statement, previously known as the profit and loss account, basically provide us information about how good the organization performs during the last year. Normally, we prepare these income statement per year, but sometimes we can, based on the requirements, we can prepare it for quarterly, or maybe we can prepare it for monthly. It doesn't matter. It depends on what you really need. But normally we prepare them for a year. So if you think about that, so what you get out of this income statement is basically how good the organization have performed during the past year. So these income statements and whatever the financial statements, here we are discussing about financial statements or set of accounting processes that we can apply for a profit making organization. So there are other set of accounting principles and practices that we can apply for non-profit making organization as well. But here our main intention is basically towards profit making organizations. So if it is a profit making organization, the performance would be actually the profit. So how much of a profit that we have made during the last year or the previous accounting year. So that would be the outcome that you can get out of this income statement. So that is the first one. The second one is statement of financial positions. Some people call it balance sheet. That was actually the name that we previously call it. So statement of financial position, the name itself give away the idea. So basically what it does is actually it provide us a snapshot of the financial position of the day that we preparing this statement. Let's say the statement is being prepared for 31st December 2024. So that means it will give us a snapshot of the financial position of this organization on that particular day, that is 31st December 2024. Snapshot in the sense how much of assets we have. It's like basically then we can divide those assets into long-term, short-term assets. Then on the other side, we can have how we have find out money to finance those assets. Let's say we have like buildings, machineries, vehicles, and other equipments, as well as some other let's say short-term assets like stocks. So then on the other side of the statement, we have how we have find out money to buy those assets. Probably maybe you might have issued some shares, or maybe you have gone for a bank loan, or maybe you have issued debentures, whatever it is. How you have find out money. So when you finance your organization out of the money, basically you have to finance it out of the money from other parties. So it becomes a liability. So this is actually a balance between liability and the assets of the organization. That's what you get out of this statement. So that you can have some sort of idea how much of assets we have, how much of liability we have, what is our structure when it comes to our financing, how much of debt that we have, how much of capital we have, things like that. So then we prepare something called statement of cash flow. Again, very important statement. Let me tell you why we specifically need this cash flow, because somebody might, so you should ask this question actually. So now we are preparing income statement where you can get the profit here, right? So why we really need to calculate something again connected to the cash flow? So it will also give you the surplus or deficit of the cash balance available at the end of the day. End of the day in the sense end of the accounting year. The day that we prepare this statement, let's say 31st December 2024, something like that. So if you think about it like that, you might ask the question why we really need to do it again, because we already have the profit. So basically that's what we have. So why we really need to bother about calculating another statement, or maybe calculating another balance where we can find out sum of money that we have at our disposal. So any answers for that? Why should we really find out that balance at the end of the day? Anybody? Any idea? I would really like if you all can actively engage with the day school. So whatever the session that we are conducting, so we can have a very good convocation.
Sorry, sir, can you open the question again, please?
Yeah, the question is actually now if you think about we can calculate the profit for the accounting year using the income statement, and we can look at the financial position using this statement of financial position. Again, now we are going to calculate something called cash flow statement, where it shows whatever the deficits or maybe the surplus of cash available at the end of the accounting year. So my question is, does it really necessary? I mean, is it really necessary for us to calculate this statement of cash flow as well as income statement? Why? Any idea? So this statement gives you the profit. This will gives you the surplus of cash or maybe the deficit cash, whatever. Positive or negative balance cash at the end. Yeah. So one answer comes from and a student, he says that evaluate the performance and the sustainability. Okay, so you can evaluate the performance using income statement and look at the sustainability through the cash statement. But anyway, in the financial position, we normally have the cash balance as well. So main reason why we really need to calculate something called cash flow statement is actually have to do something with the accounting principle. So I hope that you all have learned something called accrued principle and cash principle during previous 2 days. Rahman, you have raised your hand. Do you have anything to ask?
No, sir, no.
Right. So why? Because in principle, when you do your accounting process, when you make the treatments to your transaction as well as like events that take place in an organization, when you report those things in an accounting process, you use something called accrued principle. Accrued principle is where you record anything that is relevant for the accounting year, even though that has been paid or received by cash. That is not a concern. The main concern when it comes to the accrued principle is whether that particular item or the transaction or the event is actually relevant to that particular accounting year. Let's say if the accounting year ends from December, let's say December 31st December 2024, if any transaction is related to that. So even though you paid it out of cash or not, you are going to report it. So things like that. Let's say this, for example, if your accounting period ends from 31st December, but sometimes you might not have received your electricity bill, or maybe you might not have received your water bill, things like that, your utility bills for the month of December. So those bills might reach you in January. But still, even though you have not paid it in December, you have to consider it because that expenditure is basically relevant to that particular accounting year. So that is the treatment. So that is where you use something called, or maybe the principle that we use, accrued principle. So you prepare all those financial statements, income statements, and statement of financial position based on that principle. So we really don't know, even though you have a profit, we really don't know that profit have yet been realized out of cash. Sometimes you might not have cash at hand, even though your statement shows that there's a profit. So therefore, it is very important for us to take a look at what happened to the cash flow, how much that we have, what is the outflow and what is the inflow. That is the main concern when it comes to that step. And at last, we have another statement. So that is actually statement of changes in equity. So at the end of the financial year, what we do is like we prepare this statement to understand what happened to the ownership and how much of the profit that we have distributed among owners, and how much of the capital that owners have uh, taken out of the organization, and then how much would be the total equity at the end of the year. So what sort of changes taken place in terms of equity. So we are really not going to pay much of attention to that particular statement today, but still, mostly we would be paying attention towards income statements and statements of financial position. And we obviously we have some notes. So we are going to get lots of notes for each and every item in these statements. So those notes actually elaborate more on those numbers, how they get into that final number, right? So this is the main idea when it comes to financial statement. And I hope that you all have some sort of, you all got what these statements are. So we will move into the next part. So I mentioned that these financial statements are important because it makes us read the business, how good that business is and all. So let me explain a technique that we can use to evaluate these statements, something called ratio analysis. It is actually a very simple concept. We combine two or three elements or two or three items from these financial statements together and create some ratios, which we can give some sort of a subjective understanding of those numbers. Like if you just tell the profit, it doesn't make much of a sense because it gives you some sort of a absolute value. But if you compare your profit with the sales and you report that as a percentage out of the sales, then it has a context, and then you can make some of the decision connected to the profitability. Like likewise, why we create these ratios, so that it makes it very easy for us to understand it, because it's a ratio and it's a single number. Rather than looking at whole statement, if you look at a single number, then you can come into a conclusion what we should uh, do about it. So why we create ratios? Because there are numerous usage for those ratios. Because these financial statements are mostly, if you are talking about uh, public companies, I mean, that is companies that are registered under Columbus Stock Exchange, let's say. So they will have to publish all these financial statements all the time. So why? Because there are other people uh, we actually call them stakeholders. So not shareholders, but stakeholders. Stakeholders are a set of people, or maybe group, or maybe organization, or maybe institutions that are influenced by, or maybe are interested in organization, or whatever the organization that we are talking about. Let's say if you're thinking about let's say Laugh Gas, or maybe Laugh as a company. So there are numerous entities out there who are interested about the performance of that company. It could be the government for the purpose of getting taxes. It could be employees uh, to know about what sort of a situation that we are in at the moment. It could be shareholders, because they want to know about how much of a dividend that they get, what sort of performance that they have made during the year. And maybe other banks, because they might have loaned out into those organizations. And some other organizations, like people who are analyzing companies, and rating those companies, financial advisors. There are a lot of people who are interested in this information. So therefore, if you think about, now, you might not be directly connected to this area. Sometimes you might be connected to marketing area, or maybe purely into supply chain area. But still, having able to read all these financial statements and have some sort of understanding and evaluation about these statements, and what exactly those things communicate, would come handy anybody working in a organization. So that's why this is very important. So we are going into this area today. So let us go one by one. So these statements, since I have already explained to you, so I'm not going to explain it to you again, but just to summarize it, like, the income statement provides you the financial summary of the organization. Basically, it's the operating results in the sense. So operating activities are the activities that you conduct. Those are the main activities that you have establish your organization for. Like, so let's say your organization is selling furniture, so your main activity is actually producing or maybe purchasing furniture and selling it. So that is the operating activity. So operating results would be basically the profit that you have earned out of that activity. So income statement gives you that. As I mentioned, most commonly income statements are, like, prepared for 1 year. That year is called accounting year. So sometimes you can prepare those things to quarterly, or maybe mostly we prepare those things quarterly for tax purposes. But for other, like, decision making purposes, probably we can calculate all those things, like, maybe semi-annual or maybe monthly. So this is actually this is a fundamental version. Like, there are several variation when it comes to the practice, but this is actually a fundamental, a very basic version of a income statement of a company. If you go through one by one, I would like all of you to pay attention towards this. So first we have sales revenue, obviously. So that is what you get. That is your income. So here it's 1,700. So you can see on top of it, so we have the title. So that is basically this particular one is created. Let's say income statement year ended December 31st, let's say 2024. So these figures are in 1,000 forms. So that's why it is here. Right. So first we have revenue. Then we have something called cost of goods sold. Right? Cost of goods sold. So what do you mean by this cost of goods sold? Anybody who can explain this? Anyone? Cost of goods sold.
The actual cost of the inventory.
Yeah, of course. So not the inventory as such, but the actual cost of the inventory that we have already sold. So the revenue is being generated by selling some, let's say this organization sells computers. So the revenue is generated by selling computers. And what is the cost for those computers that we have already sold? So that is basically cost of goods sold. So when you get the set off out of those two figures, obviously you are going to get something called gross profit. Gross profit. So that is actually sales revenue minus cost of goods sold. So this is the figure here. So I'm not interested in these figures, but I am interested in these information. So then what we do, when you arrive at the gross profit, we are going to get something called operating expenses. So operating expenses are the expenses that we have to incur due to main operating activities. You remember the operating activities? Let's say now this particular organization sells computers. So their main operating activity is selling computers. So these are some of the expenditures that they will have to, like, incur just because of these operating activities. Let's say selling expenses. These are the expenses for, your marketers. Like, if you have given your discounts, or if you have done some advertising, or maybe you have, like, distribution of computers to different locations. So those are the things that coming under the selling expenses. And then you have general and administrative expenses, like, administration, stationaries, and managing, keeping management, and, accounting also coming under this, and all these administrative expenses. And then you have depreciation of assets that you have, that is purely connected to the main operation of the organization. Let's say you have vehicles, you have office space, maybe you might have like other equipment, so you need to add amount for your depreciation, because these assets are not going to last forever. There is a effective lifetime for any asset, even for us, anything that in the world, there is effective lifetime. So therefore these things are not going to last forever, so we need to purchase these things again and again, but during the lifetime, sometimes maybe by 5 years, or maybe by 10 years. So therefore we need to have a separate fund, because of that particular purpose we are depreciating all the assets. So once you get rid of all these things out of this gross profit, I mean the operating expenses, then you are arriving at the operating profit, something called operating profit. So this is the operating profit. So I think you understand it. So first we have your sales, and then you get rid of cost of goods sold. Then you arrive at something called gross profit. Then you calculate something called operating expenses. Then you deduct that amount from your gross profit. Then you arrive at something called operating profit. Operating profit. So then we are going to remove your financing expenses. These are actually mostly interest expenses. What do you mean by financing? Let's say you get a bank loan to run the organization. So the interest that you have to pay for that bank loan comes under this. That is expense. You have taken that bank loan because of the fact that you want to run the organization. So you have to pay the interest. So that is actually a financing cost. So you have taken out a bank loan because you need to finance your project, let's say your organization. So that is a cost. So that part comes after the operating expenses. Then you deduct that part from the operating profit. Then you can arrive at something called net profit, but before taxes. So taxes is very much a part of the organization. So then you can remove your taxes. So here I have put 40%. So these taxes to be paid for the government, these are corporate taxes. So you remove the tax amount, then you are arriving at net profit after tax. Net profit after tax. So this is the amount that is actually belong to your owner. Owners of the organization. It could be stakeholders, shareholders. These are the shareholders. So this is the amount that is belong to them, because you remember this particular interest expenses goes to sometimes maybe to a bank, or maybe for a debenture holder, who is a debenture, or maybe bond holder. Who is a debenture holder? Somebody who has given us a loan, like that is actually the most basic version of that. So organizations can issue, or maybe they can sell debentures, bonds, and collect debt capital out of the public, so that they can run their organization. So debenture holders and the banks are actually providing us loans. So they become our liability, and we will have to pay interest. So here the 120 is basically a tax. That is the amount that is belong to the government. And then what is available for us as the shareholders is 180. So this 180, you can do two things. First one, you can distribute part of that as what you call dividends for the shareholders. Dividends. And or maybe you can keep part of it within the organization, and then we can reinvest that amount within the organization itself. But here we have paid something called preferred stock dividend. So stocks can be, there are several versions of stocks. Shareholders, so these are preferred shareholders because they get priority. They get the priority to claim for the organization's profit before the common shareholders. So that's why that part is coming first before the common shareholders, because common shareholders only have 170. So this earning per share, it is actually a ratio that we should discuss. So what it does is actually it divides total amount that is actually owned by these shareholders per year, and it gets divided by the number of outstanding shares at the moment. So that's how you calculate it. So that is how you are going to read your income statement. So as I mentioned, this is actually very fundamental basic version of in income statement. So if you go through, like, several, everybody can download these income statements if you logged into Securities Exchange Commission website, or maybe even in Colombo Stock Exchange website. So we have separate industry classification. Under those 20 industry classification, we have several companies listed. So each and every company needs to publish their income statements there. So anybody who is interested in looking at those income statements can go to those websites and take a look at it, whether these elements are there, whether you can understand those things. I am sure that most of these elements are there, and some other also. So it depends on the organization and the nature of the organization. There could be some other items, but these things should be there fundamentally, right? So this is how you are going to read your income statement, right? I hope you will understand what I'm trying to tell. If you did not, please feel free to disturb me at any time. I will explain it again. Right. So then we have statements of financial position. Now we know what it exactly shows. It shows the summary of the assets and the liabilities of the organization. That basically the financial position of organization. Right. So we'll straight away move into an example. So as I mentioned earlier, this is actually again a very basic version of the statement of financial position. So let us go through it. So first, the first section of this statement are basically dedicated for the assets, and those assets we can divide those assets into two parts. First one, current assets, and then we have fixed assets. All right. Current assets and fixed assets. So if you take a look at this current assets part, so under current assets, we have cash, marketable securities, account receivables, inventories. Okay. So before moving to this, I really need some explanation from you. So I'm asking the question, how do you really define an asset? How do you really define an asset? How do you identify an asset? Let's say probably now you all are coming to this particular session through a laptop. Is that laptop is an asset for you? Any answers?
If it is generating some income for us, it is a asset actually.
Of course. So how do you identify an asset?
It can be
If you
it can be it can be some it can be any resource. Either you
Yes.
own, or maybe you're controlling, or maybe individual is controlling, or a business, or a partnership is controlling. So
Yeah.
that kind of entity.
Right.
uh, answer, shall I give my answer?
Yeah, of course, of course.
Yeah, asset can be anything that uh, can give economic value,
Yes, of course.
present or future.
Yeah, true. Right. So if you combine all these answers, so asset could be something that you can touch or maybe you can't touch. It could be tangible or intangible, but it should provide future streams of cash flows, future streams of cash flows, and you should have the ownership for that particular asset. So those are the main two things that we can count. So if the organization we are counting we are counting an asset as our asset, you need to have some ownership for that particular resource, and that asset should create future streams of cash flows, future streams of cash flows. Right. So that is how you identify assets. So that's why I asked the question whether your laptop is a asset. Yeah, if it could be a asset if that produce a future cash flow. So sometimes your laptop may not be an asset for you, but my laptop would be an asset because I'm conducting lectures through the laptop. So I'm going to earn some money out of these laptops. So if you are also earning anything out of your laptop, using your laptop, it could be counted as an asset. Otherwise, it really become an expenditure. It will not become an asset, right? So that's the difference between expenditure and asset. So both of them are actually expenses. So because if you want to own asset, you have to spend money you have to buy the laptop. So it becomes an asset when you are earning out of it, right? So otherwise it becomes an expenditure. So that's the understand. So all these assets can be divided into two parts depending on how far it is going to last. So the main deciding point is if there is an asset that is not going to last more than a year, that is not going to last more than a year, those assets are categorized as current assets. So then rest of the assets would be categorized as fixed assets. So that's the idea. So under current assets, we have cash, marketable securities, account receivable, inventories. Do you see any order here? If you think about those things, cash, marketable securities, account receivable, inventory. Why we have put cash at first and inventories at last? Any understanding about it? Any hint?
It is a I can't remember the English word.
That is actually liquidity. Yeah, liquidity.
Liquidity assets.
Yes. Yeah. So depending on the highly liquid asset, most liquid asset we have is actually cash. Liquidity means how fast we can convert something into cash. How fast and without incurring much less cost. So cash is actually cash. So that is the asset that has highest amount of liquidity. So then we have marketable securities. Marketable securities are actually securities that we have bought out of the by selling some, maybe by selling our debts, and also those securities can be sold in the market. And then we have account receivables. So account receivables are actually the accounts receivables create when you sell on credit. So let's say you sell on credit, then there's a person that out there who should give us the money, so that person becomes our debtor. So we need to collect money from that person. So that becomes a current asset because we are definitely going to collect that money during the year. So it's not going to last more than a year. Then we have inventories, basically the stocks that we have. If this organization is selling computers, so we have stock of computers. So that has the least amount of liquidity because first you have to sell it, and then you have to collect money out of them in order to convert into the cash. So account receivables is actually one step ahead than the inventory because the selling part is already over. What is remaining is to collect money out of them, right? So that's how we order those items in financial position. Sorry, in statement of financial position. So I hope you got the idea. So then we have fixed asset parts. So we have land, buildings, machineries, fixtures and furniture, and vehicles So that is also they are based on the order, based on the liquidity. So there is a specific part here, because if you think about these current assets, normally we do not depreciate them because that is not going to last more than a year. But still, when it comes to fixed asset, we have to depreciate them. So there's a specific part in order to add accumulated depreciation in the statement of financial position. So all these things are accounted based on the cost. So these are the values, and then you get the gross value, then you deduct your accumulated depreciation. Accumulated depreciation is actually the amount of depreciation that you have done over the years for these assets. Let's say, for example, this vehicle, you purchased it in the last year. So last year you might have depreciated, and this year also you have depreciated. So those two figures get accumulated in this figure here, right? So that is actually accumulated depreciation. So then we have net fixed assets. So how you get it? So you get gross fixed asset, that is the cost of all the assets, fixed assets you have. Then you deduct your accumulated depreciation, then you get the net fixed assets. So net fixed assets plus your total current assets is going to be equal to your total assets. So one part of your balance sheet or the statement of financial position is done. So that is basically asset. So now this means on this particular day, let's say this is 31st December 2024. So on that particular day, you have this amount of assets. So you have $3,200,000 worth assets at this particular day. Right. So these are the breakdown for that. So let us move into the next part of the balance sheet, where you are going to find out how you have find out money to buy those assets. This is how. So in this section, we have something called liabilities and stockholder, or maybe shareholder equity. Liabilities and stockholder equity. So first part, we have liability, then we have shareholders equity. So liability can be divided again into two parts: current liability and long-term liabilities. So the same rule applies here. Any liability is not going to last more than 1 year, is going to be categorized as current liabilities. So here we have account payables, note payables, accruals listed down here. So account payables are basically created when you are purchasing whatever based on credit. So you have the obligation to third party. So you need to pay those amount to those parties. So that creates account payables. So notes payables are basically the same thing. And accruals are the things that we discussed earlier. Let's say the something like this, utility bills at the month of December, you have not paid that amount, but you have taken that amount into your accounts, That is basically depending on the accrual principle. So let's say, like, electricity bill for the December month, you have not paid, but still it is shown in your profitability or maybe in your expenses as it is paid. So that's why it's become accrual. So you have to pay it, but you have not been paid it yet. So these are all short-term obligations, debt obligation precisely for the third parties, right? So that's it. That's how you categorize it. Then we have total current liabilities. Then we have long-term debts. So here you probably have like bank loans, and if you have issued debentures or bonds, corporate bonds, that could be listed under here. So mostly bank loans and debentures and bonds. There's a slight difference between debentures and bonds. The difference is actually bonds are more secured when you compare that to the debentures, because bonds are basically issued against a collateral not so much with the debentures. So debentures are basically issued against the goodwill of the organization. There is no secured collateral against the debentures. So that's the difference between debentures and bonds. Other than that, it's the same thing. Then you get the total liability when you get the accumulation of the long-term liability and the current liabilities. So this part, total liability, is actually what is owned by the third party, not by the organization. Like, anybody outside the organization, anybody who has given us money outside the organization will come under here. So the next part is shareholders equal. So this is where we represent shareholders' money. Shareholders' money. So that is also a liability in grade. I mean, if you like, look at it as a bird eye view, it becomes, if you like, widen the definition for the liability, shareholders equity is also part of the liability, because anyway the organization needs to pay it out, because organization is a separate legal person and your owners are separate legal persons. So organization, if owners have invested within the organization has a obligation to pay it back to the owners when the organization is going to be, let's say, dissolved, like let's say shut it down. Right. So under that we have preferred stock. There are several versions of stocks like that: preferred stock, common stock. So we have, in this example, we have preferred stock, common stock, and paid in capital in excess par for the common stock. These things will not come now, because in Sri Lanka at least, and we have retained earnings. Right. So those are consisting of equity. So you get the total of total liability and shareholders equity. So there you have your liability and equity. So this amount should be exactly as equal to the value of the assets, because this is how you have purchased your assets. This is how you have find out money to purchase your assets, right? So this is how. So you have asked money from third parties. You have asked money from your own owners. So that's the way this is structured. I hope you have some sort of understanding about what we are discussing here. Again, if you do not have anything, if you do not get anything out of this, please let me know. Right. So moving into the next part. So statement of the cash flow, as I mentioned, I'm not going to talk about it much, but still we have already discussed why we should create something like this, because of the fact that we are calculating our income statement as well as the statement of financial position based on the accrued principle. So we do not have any clue of how the cash flow has behaved, what sort of outflow that we have, what sort of inflow we have, what is the final outcome of it. So therefore it's very important. So normally we like, structure our cash flow statement based on this ground. There are several ways that we can structure it, but this is the most popular way. So what we can do, we can divide all the activities of the organization into basically these areas: investment, financing, and operating activities. So money generated out of the investment activities and money, cash outflows and inflows. When it comes to investment activities, you get the net inflow of the investment activities. Then financing activities also the same, money inflow and outflow, and operating activities would be the expenses. So this is how you divide it. So investment activities are basically your purchases of assets. These are the purchasing of assets. Those are basically expenditures. There is nothing much when it comes to the investment. There is nothing much that you can get in Basically, those are the items that goes out of the organization in terms of cash. Then when it comes to financing, it is basically how you have find out money. So those are actually cash inflows most of the time. So those things are coming from new public share offers, or maybe debenture offers, or maybe out of bank loans. Sometimes you might have taken retained profit, or maybe out of debt that you have created. So you might have financing your investments. So then operating activities are basically, as I mentioned, like selling expenses, administrative expenses, salaries, and all that. So the payments that we have paid for those activities. So when you get those three areas together, then you have some sort of understanding how we have paid our money out and how we have received them back. Then you have understanding about what has gone wrong, or maybe what has gone right in terms of cash outflows and inflows of the organization. Right. So this is again a basic example. So let us go into that straight away. So as I mentioned, so first we have cash flow from operating activities. So under that we have net profit after taxes. So that is, we have taken it out of the income statement. So then what we do, we add back depreciation. You know that depreciation is something that we are not paying out of cash, even though we consider it as expenditure, right? It's a provision that we keep with us because we know that one day we will have to replace these assets. So that is something that we deduct out of the profit, but we never paid it out. We never paid it out. So therefore, we are going to add it back. And then decrease in account receivable, we are going to add it back. Decreasing the account receivable means, what do you mean by account receivables? That those are the set of money that should be paid to us, that should receive to us from somebody else. So that when that amount is reducing, that means they have already paid to us. So that therefore decreasing in account receivable needs to be add back to the profit. And then decreasing inventory, what do you mean by decreasing inventory? That means, what is the reason for decreasing inventory? Normal reason. It could be maybe damage or something like that. But normal reason is basically we sell it. That's why we decrease the inventory. So when you are selling it, that means you are creating money, you are getting inflow. So we are going to add it. And then increase in account payable, that is actually split opposite of the decreasing in account payable, account receivable. So increasing account payable means you have now just think about it. Decreasing account receivable means other people have paid to you. Increasing account payable means you have not paid. So you have keep that money with you. So that part has to add into the profit. That part has to add into the profit. Then decrease in accruals means, that means you have paid it out. Like if you have accruals, that means like, in December month, you have not paid your electricity bill, then it has decreased. That means you have already paid it. So it's a cash outflow. So only outflow that we can find here is this. Just think about it now. If your account payable has decreased, that means it should be outflow. If it is increased, it's an inflow. If your inventories has increased, it's a outflow. If it has decreased, it's an inflow. If your account receivables has decreased, it is actually an inflow. If it has increased, it would be an outflow. So that's the idea, right? So nothing crazy about it. So then we have cash provided by operating activities, the total. So these are the operating activities, selling your inventory. So this is the amount that you have generated out of that. Then we have investment activities, that is basically increase in fixed asset. That means you have purchased some fixed assets, or maybe changes in business interests if there is a change. So as I mentioned, these are all outflows because we have paid money. Those are expenses. Investment in the sense you have that those are capital expenses. You have purchased capital equipments like fixed assets basically, right? Then we have cash from financing activities. So those are basically as we mentioned here, decreasing in not payables, some of the financing activities. So increasing in debts, increasing in shareholder equity, dividend paid. So when you are paying out the dividend, that means you are paying something that you can reinvest, paying out of something that you can reinvest within the organization. So that means your money is going to go out. So that's a cash outflow. So when you have an increase in long-term debt, that means basically you have taken in a loan. Like you have gone for a bank, then you have asked for a loan, then you have received the loan. So that's why your bank loan account has gone up. So that means you are getting money. So you get all those things together. That means you are going to get this particular value. That is basically all the money that is created from the financing activity. So you get all these values together. So this is basically outflow. So amount of balance at the end is here $500. So this is how you calculate something called cash flow statement. And this is actually again a very basic version of a cash flow statement. If you think about a group of companies or maybe a company is a very big company, it could be really different from this one, but still you would be able to find out these items, in any cash flow statement. Any cash flow statement. Right. So statement of changes in equity. So I'm not going to explain it much. So let us go into the ratio analysis. So before I move into that, let me check on the time. Now it's 7 past 18 minutes. So when are we supposed to stop the class? Is it at 9?
Yes, and
It's at 9, right? So another around 2 hours, to go. So do you really need a break at this point, or are we really going to continue? If you need one, we can go for 10 to 7 minute break, or maybe 5 minute break and get back into the discussion. Do you all really need a break, or shall we continue this? Anything? Any feedback from you?
So let's have 5 minutes break.
Yeah, that's good. Okay, so let's have 5 minute break, and then I'll come back. Now it's 7 past 19. So I'm going to come back at 24. So we'll start with the ratio analysis. Then we will discuss about those areas. Okay. So and when you're coming back, if you have any questions to ask, please be ready with that also. So I will be able to answer those questions. I know these are not that much of difficult things, these are very basic things. So as this subject basically, so we will have to discuss those basic things in this subject because this is a very basic subject. So, right. So we'll take the break and we'll come back by 5 minutes time. Right, welcome back to the session. I hope all of you are here.
Yes, sir.
Right, can you, yeah, you can hear me, okay.
Yes.
Right.
Yes, yes.
Clearly show at the very beginning of the session. So, at the very simplest way, as I mentioned earlier, so ratio is just simply combining two elements or maybe three elements that you can get out of your financial statements. Now, why we really need ratios? Why we really need ratio? That is actually a very important question. Now, you now witness like, very basic version of financial statements. So we discuss what are those elements that you can find out in a financial statement. But by looking at those large amount of details, it is really, really difficult for us to get into some sort of conclusion. Right? It's really difficult. So you have to go through all these information, which takes time. And as well as it takes some sort of understanding as well. You need to have very good understanding of what is going on of the business. But we have come up with a solution for that by combining several elements. We can create some meaningful ratios so that we can evaluate the statements using ratios in several aspects. So that's the understanding. So this information contained in those four basic financial statements, as we all know, those information are very important. So it has a minor significance for different kind of stakeholders, as we mentioned earlier. So therefore, it is very important that we create, or maybe we combine several elements and we create some ratios so that we can have subjective understanding of it rather than having objective understanding, a comparison sort of a situation, right? So what we do, so we get those information out of those statements and we create some sort of relative measurements. So relative measurements, the keyword is here actually relative. So we create a relative measurement so that we can have a subjective understanding about it, right? So it's like, dividing some number from another number, or maybe multiplying one number from another number and dividing it by another number, or maybe deducting one number from another number and deducting and again dividing it by another number. It's nothing much when it comes to the calculation, but it's really important for us to understand how we are going to interpret those things, those ratios, what those ratios actually tells us. That is the part we are interested at the moment, not actually the calculation part, because it's like, very minimal thing to do. Yeah, like, fifth grade student can do these calculations. So we are not so much interested about calculation. What we are interested is actually how we are going to interpret those ratios, right? Okay, moving in. So these things, I think we have already discussed about these things. So this is the part I discussed. So type of ratios, type of comparisons that we can do. So it's all about comparing. So what are the ways and means that we can compare? So here we have like three types of analysis we can do. First one, we can do a trend analysis or time series analysis, right? So what we do here, we compare our own past performance with the current performance. So what we do, we calculate all these ratios for the current year and then we compare with the previous ratios. Think about it. When it is ratio, it makes it really easy for us to compare because that is standard. So let's say if you are going to measure the profitability using profitability ratio. So what is a profitability ratio? You divide the net profit by sales. then it becomes a percentage value. So that is similar across the board when you say profitability ratio. So similar across the years. So it is easy for us to compare without any compromisation. So therefore, what we do in here in trend analysis or maybe time series analysis, we compare ourselves, like current sales with our past sales, and check whether we are performing better or maybe worse, whatever it is. Then we have cross-sectional analysis, where we are comparing ourselves with our other competitors. So we compare ourselves with the competitors or our own players within the industry, same players within the industry. So there are two ways that we can go for this. We can compare our results with our direct competitor. Let's say the company is Manchi, then we can compare our results with Melbourne, then see how we are doing against our competitor. Or maybe you can go for a industry benchmark, in industry average. Let's say we have within the industry, let's say the industry is telecommunication industry, so we have around 3 to 4 players within that industry. So we get the industry average, let's say the industry benchmark ratio amount, then we compare ourselves with that industry benchmark and to see how we are doing against others in our industry. So that is the way, two ways that we can use. And then we can use combined analysis. We can do both of them together, like trend analysis as well as cross-sectional analysis. Right. So then what are the areas? Now I said that we can look at on these financial statements in different perspectives. So these are the perspectives that I'm proposing here. These are very important concepts when it comes to a profit-making organization. So profitability is all important because everybody is interested in profitability. So if it is an owner or whatever the stakeholder, everybody is connected, is interested in profitability. So that therefore we need to evaluate the profitability. Then think about liquidity. So this liquidity and profitability goes hand in hand. So first, I am not going to explain the word profitability because come on, we all know what it exactly it is. So I'm going to combine these two together, liquidity and profitability, because those two mostly goes hand in hand. So let me explain it. So profitability is basically we calculate it like difference between sales revenue and your expenditure. So very simple, basic notion there. So nothing to brag about, right? So the profitability can be calculated in different ways, different formulas, but still we are calculating our performance against something else. Like, we can calculate performance against sales or performance against total assets, or maybe performance against total capital, or maybe performance against total assets, whatever it is. It's at the end of the day, it's the performance, right? So there are several ways we can do the calculation. But what do you mean by liquidity? I think we have discussed about liquidity. So that is when it comes to liquid assets, right? That is when it comes to liquid assets. So how we define liquid assets? So any asset that can be quickly translated into cash without bearing much of a cost, we call them liquid assets. Quickly transfer into cash. So how you apply that concept into an organization? Liquidity. If you think about an organization who is having a motive to create profit or maybe make profit, how do you apply this concept, liquidity? Or you can apply it to yourself as well. So think about those two perspectives. How do you apply it to you, or maybe how do you apply this to organization? What do you mean by liquidity when it comes for an organization? So I need some answers. Or maybe those are all opinions. Like there are no right, wrong answers. You can have your own opinion. So I'm asking that opinion. So can you please provide some? Anybody? What do you mean by liquidity when it comes to the organization? That's the question that I asked.
Liquidity doesn't have to be assets always.
Doesn't
Maybe
have to be always.
assets always.
Assets always. All right. Okay. Agree. Any other understanding? It's like this now. You think about yourself, like you think about yourself, like let's say you have a lot of money in your bank account, you have several credit cards, uh, you have a lot of assets, maybe you have a car and you have a house also. But still, if you are going around, you're in the university and you want to have a cup of tea and the canteen does not accept your credit cards, if you do not have cash with you, you're not in a position to have that one. Like you are not in a position to purchase the cup of tea that you want. That same principle applicable for the organization. Even though you have a lot of assets, even though you have a lot of bank account, I mean, a lot of money in the bank accounts, maybe sometimes you might have money in different investments. But still, if you do not have enough cash to run day-to-day activities, you are in big trouble, because you won't be able to meet the day-to-day needs. You won't be able to, most importantly, you won't be able to meet day-to-day debt obligation, that the amounts that you have to pay to third parties. When you are not paying those amounts, there are problems, because that means your supplier is going to go off rails. They are going to go off the radar, because you are not going to pay to them, so they are not going to supply to you. So like banks going to go for war, because you are not going to pay your installments, your bank installments, so they are putting pressure on that end. So therefore, liquidity is important as much as maintaining high amount of assets with you. It doesn't mean that you have a lot of assets in lot of different forms, like maybe in buildings, uh, lands, and maybe in vehicles, but it doesn't mean that you are okay, you are secure. Of course, you are secure when it comes to long run. You can always sell one or two assets and convert that into cash, but it takes time. Therefore, we need to keep some amount of money with you so that you can, maintain the day-to-day work. So that is about liquidity. So that's what we are going to trying to find out, whether this organization is liquid enough to run the day-to-day activities. So that is the one aspect that we want to look at. It is basically ability to satisfy short-run obligations when it comes to the organization. Right. So why liquidity is important? So this basically shows us whether the organization has short-term cash flow problems. Whether the organization has short-term cash flow problem, whether they are able to survive the short run, which is very important. This liquidity is even more important for banks. You have heard about banks, like they need to keep a balance between liquidity and profitability, because if it is a bank, you basically purchase money, like you purchase money and you paid out interest. So your whole inventory becomes money. It's an inventory of money. So then you are loaning them out to people, and you do some project and you invest in some areas as a banker. So, but still, those depositors are normally coming into the bank and claiming their money back. So you need to maintain certain amount of money within the bank. So when you are maintaining certain amount of money within the bank, it is not going to be profitable. Why? Because if you want to be profitable, you have to loan them out so that you can earn an interest. If you are going to keep it under the pillow in the bank, like it's not going to produce any penny. Like it's not going to give you any return, right? So it is basically applicable for your organization as well. So if you are going to keep some money as your day-to-day work, the word is actually working capital. So if you are going to keep, or if you are going to put money under the working capital, that is not going to produce any return other than the fact that you can run your work or maybe run your operating activities very smoothly. Definitely it is going to pay off at the end of the year because you have done well when it comes to your activities. But it is not the case that I am raising here. So if you invest it in somewhere else, like, if you at least put it as a fixed deposit, you could have earned like, 10%, not these days, but in general, you could have earned 10%. So therefore, you are kind of, sacrificing profitabilities for the sake of keeping liquidity of the organization. So this is even important when it comes to a bank. So that's why they always say that if it is a bank, they need to constantly monitoring these two, liquidity and profitability, because if you keep more liquidity with you, thinking that it is going to serve you well, but it is not. Believe me, it is not, because when you have enough, it is enough to run your day-to-day business. So if you are going to keep more and more, that is going to hurt when it comes to profitability. So same principle applicable when you are thinking about profitability also. If you are going to invest more and more into profits without just thinking how well we are going to face to day-to-day activities, so it is going to bring a lot of trouble to you, even though you might have a lot of money. So that's the idea. So those two, I hope you have, because I took those two together because those two has a connection. So liquidity and profitability. So then we are moving into activity. So activity is also very important. Activity is also important. So let me ask a question. So what is the main or maybe the fundamental reason there is something called economics? Why we all learn economics in basics? I mean, in theory at least, why there is something called economics? Because of what? Any ideas?
Scarcity of resources.
Yeah, of course. Yeah. That in theory at least, because of the fact that we don't have enough resources when you compare that with our needs and wants. That is the basic thing. So that's why we need to, even though the company or maybe the organization might create a profit, it could create a profit, and sometimes it might be liquid as well. But we need to check whether the organization is utilizing these limited resources effectively and efficiently. So that is where this activity comes in. So we need to find out whether the organization is doing it effectively without wasting resources. How effective are they in running their organization? So how effective are they doing their day-to-day activities? That is where we are going to evaluate the activity of the organization. Activity. And so we discuss about debt, liquidity and profitability. Then we have debt, very important. Because debt is important because it is all about long-term, sustainability, or I would say long-term solvency of the organization. Because when you have a lot of debts factoring into your capital structure, it is going to make problems. Because let's say you have 50-50 debt and capital, you have stock capital common from your shareholders, you have 50%, and then you have debt holders from banks and as well as debentures or maybe the bonds, 50%. So that is a 50-50 capital structure. So when you have 50-50 capital structure, so you do not have enough room to grow. Because let's say going out and raising money in stock exchange is really costly. You have to pay a lot, you have to pay dividends. There are a lot of things that you have to adhere into. I mean, it's a difficult task. And sometimes you might not get whatever the amount that you are expecting, because it's a market. you are going to open up yourself in the market. It's up to the general public to buy your shares. There are other ways, like, you can go for investment banker, then you can have somebody to buy and you can have a backup. Obviously, you need to have a backup. That's basically a requirement when it comes to general public offering. But still, there's a risk. But when you have 50-50 scenario, it's really difficult for you to think about expansion projects. So because if you go for bank loans, even though your bank is good and your relationship with the bank is good, you are paying interest and you have a good coverage. Then even though you have that, if you do not have enough headroom when it comes to the debt to equity ratio, it's a bit difficult when your debts overtake your equity. It shows a bad sign. It shows a bad sign about the future or the solvency of the organization when it comes to the long run. So therefore, we need to keep look at it. What is the proportion that we are going to maintain? Is it debt? How much of debt? How much of capital? There are several studies, several research. Even now, people are conducting to understand what is the best structure, but still, it depends on the nature of the organization. So we need to keep a balance there. Think about the structure, how much of debt that we are going to go for, how much of capital that we are going to have. Very important area. So therefore, we are going to evaluate the organization's statements from that perspective as well. And the last one, profitability, we already discussed. We have market ratio because market ratio is again even more important. Mostly in this free economic situation, like we are living in a modern capitalized economy, postmodern is capitalized economy. So in this free economic structure, stock market is everything. Not only the stock market is everything. So most of the things are being decided by the market. At least if it is 100% open one, not like Sri Lanka. Sri Lanka is basically, even though we are open, it's not open because market is basically manipulated by 2-3 players. We call it crony capitalization. It's not in Sri Lanka, but if you think about the world, so when the market is open, everything is decided by the market. So therefore, market indicators are very important if an organization to survive. So if you think about, very developed countries like, USA, let's say USA, so those companies, their market share is very sensitive to everything happens in the economy. So if something happens, there's a tendency that the market share is going to go down, market price is going to go down of a share. It could happen. Very, very silly incidents, it could happen. Very important areas. So it is really not difficult. It is really important for us to keep your eye on the market ratio as well. So how we are performing in the market, how would be the value of our share? What is the value of a share? So how it is being portrayed, how it is being illustrated, how it is being displayed in the market. Is it good? Is it bad? How much of a turnover that we are going to get in the market. So in terms of the market, we will have to evaluate. So those are the areas that we are going to evaluate an organization with. So there are several other areas that we can discuss, but we are going to limit our discussion into these key 5 areas. Okay. So I hope you got some sort of understanding about what we are going to do, right? What we are going to do. Okay. So let me move into the calculation part. Yeah, before that, let me give you some understanding about the summary of what we are going to calculate. There are more than 100 ratios that we can calculate using this information that we can get out of those statements. But I am going to limit ourselves into several ratios so that we can have some sort of understanding, right? So let me give you those ratios that we are going to discuss today. So first, I'm going to kick it off with, I think, liquidity maybe. So let me share that with you. So please I'm going to stop sharing and reshare the document that I have created to share. But this is the one. Right. Can you all see this document? Is it visible to you?
Yes, it is visible,
Right.
sir.
Right. Thank you very much. So this is the document that I have prepared to explain it to you. So these are some of the ratios that we are going to discuss in this section. So as I mentioned, there are several odd ratios. I mean, hundreds of ratios we could discuss, but I'm going to limit ourselves into these areas. This is, we believe that this is enough for us to have some sort of understanding about these statements. So even though we won't, if you have the basic understanding of these ratios, you would be definitely be able to understand other ratios as well. So whatever the ratio, we can put into any of these categories. There are other ways of categorizing as well, but still we prefer to categorize these ratios in this way. Right. Okay. So let me first move into the profitability. I hope you all can see all these, right? Without issue. Right. Okay. So first thing we are going to discuss is gross profit. So under profitability, we are going to discuss gross profit ratio. Most basic ratio that we could ever discuss. Right. So you can see how we are going to calculate it. So gross profit margin ratio. So all you have to do, just divide gross profit from the net sales. Net sales in the sense, most of the time in income statements, you would find net sales. Normally you are not going to find gross sales. So if you want to get the gross sales, most of the time you have to go for notes. But anyway, you can find this net sales value. That is basically net revenue in your income statement, and gross profit also you can get out of the income statement. So you divide gross profit by net sales, then you are going to get a value. You are going to get a value, right? So what does this value? So this is basically we call it gross profit margin. So I'm going to ask, because you have understanding about sales and gross profit, so we are combining those two figures together. So I'm going to ask a very simple question. So what does this mean? Let's say if you are going to get a gross profit of like 30%, what does that mean?
Profit before tax?
Yeah, of course, gross profit, it's gross profit. So it's basically the difference between revenue and cost of goods sold. That's gross profit.
It means we sell the goods of like 1,000 rupees, and we got the profit like 300 rupees. It
Yeah,
means the goods rate the cost of the 1,000, but we are getting direct profit around 300 rupees.
yeah, that is actually the case. This, if you have a, if gross profit margin, higher the better. So it's obvious now, so higher the better. So that means you when you are having a good gross profit margin in the industry, it means you have the what you call the price advantage in the industry. Price advantage. So that's how you analyze it. Like now, let's say if you compare your gross profit margin with your competitors, and your gross profit margin is higher than your competitors, that means you have the price advantage, because you can control the price, right? So even though your price is high, this means your price is actually a little bit higher, or maybe your cost is a little bit low. Whatever the way, you have the price advantage. So those are the two things that you can get out of it. when you are having a good gross profit margin, that means two things. One thing, your cost is low. So that end you are good. On the other hand, you can manipulate the price. You have the price advantage over others in the industry. So those are the two areas. Then you can dig into that, into the organization, find out what is that. So if whatever it is good. Like if your cost is low, that is good for you. If you can manipulate the price in the market, that is also good for you. But we have to be careful. There are other factors that we need to discuss or maybe consider. But still, those are the indicators. As I mentioned, now when you look at this ratio, those are the indicators that we can take out of it, of an organization. Right. So then we have something called net profit margin. Same concept. So only thing is that we are going to divide net profit after tax from net sales. Net profit after tax from net sales. There is something called operating profit margin also. I don't know whether I have included it here. So operating profit margin is where basically you divide your operating profit, like, you know, OP divided by net sales, same thing. That is operating profit margin. But I think I have not included here. It's the same thing. Same thing. So operating, the net profit margin, it gives you the same understanding. Like, you know, you can have, like, you know, when you're having a net profit margin better than, let's say, when you compare yourself with others, your competitors, if you are having a good, like, you know, better net profit margin than others, that means you are very efficient in running your business. You are very efficient in your operating work. Like, you know, you are not wasting your money. So that means your marketing is optimized, your administration is good, your management is good. That is what it actually conveys to you. Because that means your operating cost is very less. When you compare to your gross profit margin, your net profit margin is very less. That is, there are two ways that you can compare this net profit. You can compare the net profit with your own gross profit. Let's say your gross profit is like 70% and your net profit is like 10%. What does that mean? That means that you are totally inefficient in doing your business. That is in activities. You can take a look at how, when it comes to activities, how those things have gone wrong. But still, this net, when you compare those two, gross profit and net profit, it gives you the indication. If you're having a net profit margin that is complementing your gross profit margin, that means you are good. But if you have way less of a net profit margin, that indicates that you are not doing a very good job in doing your operating activities. But still, one more thing that I want to explain to you here, because when you are comparing these things, you need to be very careful, because we need to compare apple to apple, not orange to apple. That is very important. So when you're comparing, we need to make sure that we are comparing within the same industry. We are comparing within the same competitors. So when we compare, we need to make sure that we have adopted the same calculation over the years when we are comparing ourselves with previous performances as well. Very important. Right. So again, good gross profit margin, higher the better. Net profit margin, higher the better. Operating profit margin, higher the better. Same thing. Right. So those are the main things that you can take out of those two. Then we have something called EPS, earning per share. Right. So earning per share here, you can see it is a very fundamental notion. So what we do, we get earning available for common stockholders. This is basically actually net profit margin minus the preferred stock interest. So for the, if you have preferred stock, it becomes net profit after tax minus preferred stock interest. But if you do not have preferred stock, basically it is net profit after tax. It is divided by number of outstanding shares. That is basically amount of shares that you have sold into the public. Like let's say we have issued like 100,000 shares. So that would be the number. So you divide net profit after taxes. If you do not have preferred stocks, you divide net profit after taxes from number of shares outstanding. So that you get how much of profit attributable for your one share. How much of profit attributable to your one share. It's basically the net profit margin, but number of outstanding shares. Because this is very important in terms of I would say everything, like everybody out of the organization, people who are in the market are very keen about this particular number, EPS. Because if you think about stakeholder who is, or maybe the potential stockholder who is looking at on your organization to invest, so that person's their view is basically to look at EPS, how well they are doing when it comes to one share, how much of a dividend that I could expect. So that is one good indication, EPS. Even if you go more and more dig into the theory, EPS serves a very good works as a very good indicator where when you have a EPS, that means you are going to get a DPS. DPS is actually dividend per share. So some percentage out of EPS, because people are organizations normally do not pay all the EPS out as dividends. They do not pay. They have something called retained earning within the organization. I have already explained that part earlier. So when you have retained earnings, some part of the EPS, let's say like 20% or 40% of the EPS being paid as or maybe distributed as dividends, we call them dividend payout ratio. How much of a dividend that we have paid out of EPS, dividend payout ratio. That is another ratio that we can think about. Let's say 40%. So that means when you have a EPS, you know that this much of amount that you are going to get as dividends in the future. Whoever the future owner of these assets are, right? Really important. Then we have something called, this is actually mostly, EPS is one of the ratio so important, and they even publish that. I mean, in the statement itself, in the income statement itself, they normally publish their EPS. They do the calculation and they do publish. We don't want to even bother about calculating it. Every organization do publish these EPS. Right. So then the next figure that I want to take a look at is ROE, return on equity. Return on equity. So this is how you calculate it. So you divide total, so net profit after tax by stakeholders' equity. Stakeholders' equity. So what does this give? If you are a stakeholder, it gives you your ROI, basically, return on investment. So if you are a stakeholder, how much of a return you are going to get? Let's say this is the amount gets to be like, let's say 18% ROE. That means as a stockholder, you are going to get around 18% return per year. 18% return per year. That's what it indicates. ROE. So when you compare this figure with something called ROA, the next one is ROA, return on assets. So how do you calculate return on assets? It's basically you divide net profit after tax by total assets. Divide net profit after tax by total assets. So the only difference between these two ratios, you can easily figure it out. It's basically, so the denominator here is actually stockholders' equity. Here it is actually total assets. That's the difference. That's the difference. So I have a question for you. Let's say your ROE is actually like, let's say it's 18%. ROE is 18%. and your ROA is like, 17%. What does that mean? Any ideas? Or think about the other extreme. If your ROE is very high, let's say 18%, your ROA is very low. Let's say like, 10%. What does that mean? So what's the difference between these two ratios? So what sort of understanding, what sort of interpretation that we can take out of it? What are the signals that we can get?
Fixed assets are more in the organization.
Sorry, I
There
actually
are-
did not get your answer.
The fixed assets are more.
So you mean if you have a higher ROA, that means fixed assets, you're having high fixed assets.
Yeah.
Right. Okay. Any other answers?
There are some assets, it's not providing an income to the organization.
Right. Okay. So yeah, right. That means there are assets that useless for the organization. So there are so many assets that we are not using, like, we are not taking use of it.
Yes, the productivity is not there.
There, right. So that is another indication. Anything else? So think about it like this. So what's the difference between these two? Like, when you think about stockholder equity and total assets, if you remember our discussion about statement of financial position, you might have an idea here. Like, what's the difference between these two figures? So the first part of your balance sheet, that is basically total assets. The second part of your balance sheet is actually liabilities and stockholders equity. So the difference between these two figures, stockholders equity and total asset, is basically liabilities. Basically liabilities. Understood? So your first part is basically total assets. That is actually current assets and long term. We call them fixed assets. And the second section of your balance sheet is basically there are two parts, liabilities and stockholder equity. So those two should be equal together. So that means the difference between these two is basically liabilities. Liabilities in the sense long-term liabilities and current liabilities. So what are those liabilities actually? Those represents how we have financed our organization out of others' money. Have you ever heard about a concept called leverage? Leverage. How leverage works is like when you have a good organization that performs well, when you put some money into the organization, if that organization gives you a lot of money out of it, like, when you compare it with the market rate, let's say, like, if you put your money into the market, you are only going to get like around 20 to 25%, let's say something like that. Let's say you are an investor that you are looking for, you have 1 million rupees. These days 1 million rupees means nothing, but for the sake of conversation, let's say you have 1 million rupees to invest, so you are looking at on investment. Let's say if you want to put that into the market, like, let's say the market only provides around like 25% to 20% rate if you go for like, at least a better portfolio. But if you have an organization that provides more than that, what you can do is you can, like, attract some of the like, vendors, or maybe people who are keen on loaning to you, like, who are keen on buying your debentures or maybe bonds. Then you can issue your bonds and get that money in. Then you can create more than that. Let's say your organization have a ROI of like 35%. Only market only provides around 25%. So in that scenario, you can take loans in terms of, like, maybe bank loans, or maybe like, directly issuing loans to the directly collecting money from the third party public, like by issuing bonds and debentures. So when you do that, you are capitalizing on their money. So you are getting their money, you are only paying around like market amount, like you are paying 25% back to them, but you are generating 35% out of it within your organization. So that 15% is yours. So that is the situation where you are taking advantage out of the leverage, where you're using others' money to create profit, and you are only distributing market rate to them. They are happy because they are getting market rate, but still your organization is so much better, very efficient, and the organization creates more than that, and that is going to be your amount. So that's why you are going to get ROE more than ROA sometimes. That's why normally you are not going to get ROE more than RO. Mostly you are going to get ROE more than ROA. You know that stockholder equity is less than the total assets. That is obvious. But the difference between those two is basically sometimes being represented by the leverage fact as well. So the difference here is actually liability, how you have used others' money. But there are several ways that we can understand this. ROE is basically for more the ROE is more attracted by the stockholders or maybe potential stockholders, investors within the organization. So they are mainly keeping eye on the ROE. ROA is important, but ROA is basically for the management to keep eye on. Because ROA is where 1 rupee put into your organization, how much of a return that you have generated within the organization. Let's say 1 rupee. So let's say if the ROA is 35%, that means you are putting 1 rupee, you are earning 35 cents out of the organization per year. This is very important because we need to make sure that we are borrowing money, or maybe we are financing money and you are paying less than that. So if you have ever heard about something called a weighted average cost of capital. So you can compare that cost of capital in the sense like, you know, how much of money that you have to pay to buy all of those money. Now, you might get confused with these words, but you know, now interest is the price that we are going to pay for money. Let's say you want, now think about a bank. So what banks do is actually they buy money. Right? So it's like their commodity is money. They purchase money and pay the price. So what is the price of the money? That is basically interest rate. If you think about a consumption, like, you know, general commodity market, let's say you are selling bread. So you are selling bread. So there's a price for bread, and there's a demand and supply, you know, forces working together in the market and determine a price for the bread. Right? So on that price, you can demand something and you can supply something. So based on that supply and demand integration, you are creating a market price for that and the quantity for that as well, according to economics. So that is what normally happening. So the same thing happened when it comes to financial market. Also in the financial market, people purchase money. So the price for that purchased money is actually interest. So you're paying interest, right? So that's the idea. So same thing is being done by the organizations as well. These companies, they are purchasing money. Why? Because how they purchase money? By issuing debentures, by issuing shares. Typically, like, or maybe going into banks. So they go to bank asking a loan, they purchase money and they pay back the price that is actually interest. Right? That is interest. And they go for the share market, they open up their maybe IPOs or maybe seasonal public offering, whatever it is, then they open up the market for the organization, then they purchase money in terms of capital. And they go to the debt market. In Sri Lanka, we have debts. So they issue corporate bonds or maybe debentures in there, and they again purchase money for interest. So only difference when it comes to share, you are only going to pay dividends, not interest. Same thing, whatever it is, but we call it different name because in nature it's different. Right? In nature it's different. That's why. Whatever it is, we are like, you know, purchasing money by paying interest. So when you're paying interest, you have to make sure that you are paying less than what you are earning. So that is where this ROA comes in. It's very important for us to know how much of money that we can earn, 1 single rupee that we are investing in this organization, because we are raising money from the market as well. Let's say we are raising money. Let's say our total cost for money that we have collected from the market is 35%, and our ROA is 25%. So there's no point of running this business. Right? There are, believe me when I say there are businesses like that in this world, because the thing is people don't know. People don't know their ROA, and people don't know their weighted average cost of capital sometimes, most of the time. Though, at least those figures are not accurate, mostly. Sometimes. So therefore, it is very important to understand these concepts. We have to, these are very simple, basic, like, if anybody can understand these things, but still these are important. So therefore, we need to have some sort of understanding about these figures. You can see it's just one number divided by another number, but there are a lot of decisions connected to these figures. Right. So that's ROA. So that from that, I'm going to move into the next one. That is where we are going to discuss about profitability. In between, if you have anything to ask, anything to add, please be my guest. Like, if you know anything connected to these ratios, please add in. Sometimes you might be able to contribute in. Sometimes you might have a different perspective than me. Please explain it so that we all can learn. So this is actually not a, like, one person is speaking and you are getting information. It's like, it should be kind of a discussion, but it seems you are not talking in, I don't know why. So somehow let's move into the next one, that is liquidity. Let's go for the liquidity. So under liquidity, I'm going to discuss about two ratios. First one is current ratio and the other one is quick ratio. So the current ratio, if you take a look at it, how it is calculated, you can see this one, current ratio. You divide total current assets by total current liabilities. From where you are going to find out these figures? Can anybody tell me? Total current asset, is it from the income statement, or is it from the statement of cash flow, or maybe is it from the statement of financial position? Anybody?
It is from balance sheet.
Yeah, of course. So both of those figures you can get from the first section of the balance sheet, where you are having total assets. Sorry, from total current assets, you can get it from the first section. Total current liabilities you can get from the second section, where you are going to have total liabilities and shareholders equity. Right. So basically from the balance sheet. So what we do, you divide total current assets by total current liabilities. So what we are supposed to find here, how much of current liabilities that they are in order to cover one, how much of current assets are there in order to cover one current liability, in order to cover one current liability. So liquidity is actually a little bit of a complicated situation. Profitability is always, no. So the question that now I'm going to ask. So how do you evaluate this current ratio? I need answers here. Is it higher the better or lower the better? Now, when you think about profitability, always it's higher the better. If you think about gross profit margin, higher the better. Net profit margin, higher the better. ROE, higher the better. Higher the better. What about current ratio?
I think it should be lesser.
So you're saying
Lesser
that
the better. Yes.
lesser the better.
Yes.
Okay. So any other opinions? Any other opinions?
I think, sir, it is higher the better.
Higher the better. Okay. So we have both extremes. So anything else? I think we can, like, we have both the ends, so we can get them together and get the average. So middle is the better. So that is the correct answer. Because let me tell you that, like, let's say for the sake of having higher liquidity, you have high amount of current assets. So let's say you have 3 current assets in order to cover 1 current liability. So the ratio is 1 to 3 then. Right? So you have 1 liability and you have 3 current assets. So if that is the case, that means basically, but we have to be careful here. We have to compare this with the organization itself. That's why I said this is little tricky. Now think about an organization who sells, right? Think about the organization who sells bread. And think about an organization who sells aircraft. So if you compare these two organizations, the liquidity will become different as hell. The amount of money or maybe the ratio. So therefore, when you are thinking about liquidity, it is really, really important. We are comparing it with the correct industry. Very important. The next thing, if the industry is maintaining normal benchmark on the current ratio is like 1 to 2. You need to normally keep 2 current assets to cover one current liability. That way we can feel safe. We can feel safe. But it is just a general rule of thumb, nothing to do with the industry. What we have to do is we have to go and look at industry average on these ratios and try to keep maintain with that ratio. Let's say you, as I mentioned, you have 1 to 3 ratio. That means you are wasting money because you are keeping money as working capital with you, and you are not using that even because you need only 1, but you have 3 now. Right? So therefore we need to we need to understand and we need to find out a balance ratio according to the nature of the business that we run based on our industry. And then we should try to maintain, we should try to hit that balance every time that we are going to look at the current ratio. Not more, not less, just a balance. So that is the current ratio. So this current ratio is all about liquidity. So higher the ratio, higher would be the liquidity. Lower the ratio, lower would be the liquidity. But the problem is higher liquidity means higher liquidity is not always better. High liquidity, not always better. Lower liquidity is always worse. It is not even good. Having a lower liquidity, not acceptable. Optimum amount of liquidity acceptable, but higher liquidity is not always also good. Sometimes it is bad. Right. So moving into quick ratio. So in the quick ratio, what we do, we do some sort of an alteration to this current assets because we take out inventories. We take out inventories because, as I mentioned earlier, inventory is actually the one of the least liquid asset from our current asset list. Right? We have several current assets. So highest liquid one is cash and least liquid one is inventory. So we take out the inventory from the ratio, then we calculate it. Then if you have 1 to 1, that means you are good. Now you can understand the way that we are going here. Like you have a current ratio of 1 to 2, you are good. You have a current quick ratio of 1 to 1, that means you are good. That means you have 1 quick assets to cover 1 current liability, then that is good. So you don't want to worry about selling anything. You don't want to worry about selling your inventory out in order to, manage your liquidity. Even though you do not get any sales, you can manage it. So you are good, right? You are good. So that's the idea when it comes to quick ratio. So when you compare those two, if you are having a higher current ratio and lower quick ratio, that might be the reason. Maybe you are maintaining a big chunk of inventory in your organization. That could be the reason. Right. So those are the two things that we are going to discuss under liquidity. There are so many other ratios that we could discuss, but we are not going to do it here. So next one, we are going to move into the activity now. Activity now. So very important. Sometimes today, I think we might not be able to do any calculations. Probably Next time when we meet, we will do some of the calculations. Right. So activity ratio. So what we are having here is actually first one, we have inventory turnover ratio. So inventory turnover ratio, the name itself suggests the meaning of it. Like, how often that your sales, your inventory converted into the sales. That's the idea. So how you calculate it, you can see, you can divide cost of goods sold. You can divide cost of goods sold by inventory. I think you can find it here. So let me highlight it here. Cost of goods sold by inventory. So that's how you calculate inventory turnover ratio. So inventory turnover, it's as I mentioned, it's a activity. Sometimes people can take it as a liquidity as well, but it's an activity ratio. It's but it gives you like this turnover normally doesn't make any sense if you take it as an absolute value. Like the same scenario, if I take how many times your inventory get converted into the sales. That's the idea, no? So you compare a company that produce aircraft with a company that produce bread, right? So the turnover of the bread, the number of times your bread converted into the sales within a year, way higher than number of time your aircraft converted into a sale within a year. Sometimes the aircraft company, your inventory turnover might be like 2. You are only producing 2 airplanes per year. But for the bread company, it could be the 1,000. It could be thousands of them. So that's therefore, if you need to have a better sense out of this inventory turnover ratio, it is essential that you compare it with the organization. Compare it with the organization and industry within the same industry. So not moving into the other industry. So we have to mindful about it. We have to compare apple to apple. Right. So that's the idea. So again, I'm asking the question. So higher the better or lower the better? Inventory turnover ratio. If your inventory, the frequency of inventory getting converted into the sales is higher, that means it's good, right? That means your sales is you are having a lot of sales. So higher would be the better. But again, we have to keep in mind about the nature of the business. About the nature of the business. Right. So when you have that ratio, when you have this inventory turnover ratio, you can divide like, the number of, this is basically number of days you have within a year. You divide it by inventory turnover ratio. What is this? Inventory turnover ratio means number of times that your inventory gets converted into sales. It's a frequency. So you divide 360 by that frequency. That means you are going to get number of days that takes to convert inventory into sales, which we call average age of inventory. Average age of inventory. So this amount, what do you say? Higher is the better or lower is the better?
Lower is the better.
Yeah, obviously. So
Keeping the goods for a long time incurred interest. If we buy goods at a loan, so keeping the goods is, suppose now if we take an import loan for 90 days, keeping if we after imported the goods, we have to sell it off before the 90 days. Otherwise, it will be a loss.
yeah, it is actually connected to the liquidity situation. So that means if you are going to keep your inventory long time, that means you have to maintain a big amount of working capital. So you have to invest a lot of money under that. So which which actually it's not doing that, just sitting there. So it's a waste of money. Absolutely, we need to minimize the amount that we keep our inventory, minimize the number of dates that we
Yes.
keep inventory within the stock. It gives you a lot of freedom, like in terms of, as you mentioned, the interest amount that you have to pay. Sometimes you might have taken a OD, sometimes, as you have mentioned, you have taken loan for the imported goods. And on the other hand, like if you think about the cargo space, or maybe the inventory space you have, like when you are having higher uh, I mean low amount of days, like less number of days, that means you don't need much of a big store. So when you are having a high turnover, so you can maintain a very limited amount of a store, because space these days costs a lot if you think about it. So those are the areas that we can highlight. Right, so that is inventory, age of inventory. So how many days would it takes to convert our inventory into sales? So next thing, we have ACP, which is actually account, what we call, we divide collection period, that we divide account receivables from net sales divided by 365. So it is basically, now you can do the same thing here. You can calculate something called account receivable turnover ratio, and then you can calculate the average collection period. This ACP is basically average collection period. But what I have done here is, now if you combine these two ratio, you would ended up with this ratio anyway. Like, but here I have used cost of goods sold. Instead of cost of goods sold, there are ways that other ratios you can calculate using the sales as well. When you do not have, sometimes in some of the figures, some of the let's say income statements, sometimes you might not be able to find out this figure, cost of goods sold. Sometimes, if that is the case, you can use net sales. But here, if you take a look at it, what we are trying to calculate here is number of days that it takes for us to collect money from our debts. That is what it is. So you divide account receivables. Account receivables is actually amount that others should pay to us, because people who have purchased, we have sold out of credit to other people, so we need to collect that money. So that is account receivable part. And we divide it by net sales divided by 365. So basically what we get here is actually how many days would it takes to, like, collect money from the people that we should collect, right? So this is also one of the painful thing for our organization. So it's really difficult. We need to go for different strategies for that. Some people give them like discounts upfront so that they will pay money, like sooner. So there are different strategies that we can go for it. But if it is for organization, it is always, as you mentioned, it is better when you are having less number of days for this, less number of days. So if you can collect money from less number of days, that means it's always better. If it is taking a lot of time, so remember all these things connected to activity ratios. Activity is always connected to the efficiency. How efficient are you in doing your day-to-day activities? When you are not efficient, that means there is a big difference between your, like your gross profit margin and net profit margin. So that is how you understand this. So when you're not efficient, that means you have high amount of high number of days for average age of inventory, high number of days for average collection period, things like that. So that means you're not efficient. So the other one is average payment period. So this is basically other way around. So what you do, you divide account payable by annual credit purchases, divide by 365. But the problem with this ratio is it's a bit difficult for us to calculate this ratio using what you call the published financial statement, because almost all the financial statements you are not mostly you would not be able to find out this figure, annual credit purchases. It's really difficult to find out. Mostly you are not going to find it out. So sometimes people use total sales, sorry, total purchases on this. Sometimes people use cost of goods sold on this, but there are different ways of calculating. But if you have the information, this is the correct way of doing it. But when you do not have annual credit purchases, obviously you do not have, if you are going to find it out in a published annual report, it's really difficult to find it out. So sometimes people use net sales as a figure here. Sometimes people use cost of goods sold. There are different ways of calculating it, but for the time being we are using it. So what's your idea? Is it higher the better or lower the better? Average payment period. It is basically amount of time that we take to pay to our debtors. Sorry, creditors. That means we have purchased on credits. So we are not paying them soon. When you are not paying them soon, you are going to get a higher average payment period. So what's your idea? Higher the better or lower the better?
I think it's lower the better.
That means we are paying it upfront. So when you are having a low amount of dates for average payment period, that means you are losing money. That means you are paying it. So you have to, that means it is basically a cash outflow. I'm not saying that it's higher the better, because when it is higher, it becomes a problem. It should be optimum. You should not pay it really upfront, because you have to keep it to finance your own expenses. But still you can't delay it from a certain point, because when you are delaying it, it becomes a supply chain problems thing. So your supplier is going to go out and they are not going to respond to you when you are losing your next shipment. So it's a problem. So you need to maintain a balance here. You should not pay it upfront, but still you should not delay from a certain point as well. So it's an optimum situation. So then we have TAT, total assets turnover. It's basically net sales divided by total assets. So it's how many times, as a percentage, how much your net sale is, how much of a sale that you have created using total asset base you have, how much of a sale. So it's again how efficient you are producing, how efficient you are in producing your sales. If you have very huge asset base and you are producing less sales. So this happens to a lot of government organization. I think you know this better. You know that there are a lot of state-owned enterprises that is basically government doing for-profit business. I don't know. It's a different debate that whether we should allow the government to do the for-profit organization. It's a different thing that we can discuss on it. But government is doing it at the moment. Every government, for a fact, has been doing it. So it's a no-brainer to understand that they are making losses. But anyway, this is the reality of that. They have a lot of very big asset base. They are making sales, but it is not proportionate to their asset base. If you think about those SOEs, think about telecom, think about whatever it is, most of the government-owned, state-owned organizations, they have a big asset base, but sales are less when you compare to the assets. Very less. So that is that is where you waste your resources. That's why I said it's efficiency is very important. Efficiency is very important. So that is another one important area that we should discuss further. Not actually the total assets turnover, but whether the government should do for-profit jobs, like for-profit organizations, for-profit business. You can think to yourself about it, like whether the government should do it. When they do it, the next question that you should ask is who if they make a profit, that's good. If they make a profit, that's good. You can reinvest it within the organization. But if they make a loss, who's going to pay the loss? You have to think about it. Right. So moving into the next one. Right. So we discuss about debt. So then we have debt. As I mentioned, now under debt, we have like two ratios that I have listed down here. So we have debt ratio, we have times interest earn ratio. So debt ratio is very important for everyone, like potential stakeholders like shareholders, or potential loan providers like banks, or maybe most of the time even internal management as well. So what it gives you, like you divide total asset, you divide total asset by total liability. So if your total assets, if your total liability is like 50% of the total assets, that means what is the rest of 50% is basically your equity. Rest of 50% is equity. Like now this liability is basically total liability plus stockholders equity is equal to total assets, right? So what we have done here is this total liability is divided by total assets. So rest is this. Let's say the ratio is 50%. That means rest of the 50% is total equity. So stockholders equity. So when you are having a 50%, that means for this ratio, that means there is less room for you to go for like leverage, or maybe go for even for like expansion. It's a little bit difficult. And again, it depends on the company. If the company is really good, and if the company's earning is way better than the market's earning, right? Then probably sometimes with the risk, you can go for leverage, like you can go for debt financing and finance your organization out of debt. So that means 60%, let's say now you are at 50%, 50-50, you go for, then you go for another 10% debt. Then it becomes like 50-60, sorry, 40-60. 40 equity, 60 debt. Still, if your organization is earning enough, and out of that 10%, then you can earn more to your shareholders. But it gives you a question always, if when somebody is going to come and give you a bank loan, like if bank is going to evaluate yourself to give you a bank loan to understand the credit worthiness of your organization, this becomes a problem. Because banks know when you are exceeding sometimes your debt, the debt is exceeding the equity, always it creates problem. It creates a problem of the long-term survival, long-term solvency of the organization. Right? So that's the that is what you want to get out of this debt ratio. So if this debt ratio is very less, let's say like you are having a 80% equity and 20% debt, again you are doing a bad job. Because always, as I mentioned now, if the organization is making your ROI, let's say ROA, your ROA is better than what you get from the market. So if you can issue some of the bonds and you can collect some of the debt financing, then you can invest that within the organization, create some money, then you earn that 35% out of it, and you just pay 20% to those debt holders, and they will be happy because even them, they are getting a market rate. You are earning extra from those, not, that is basically others' monies. You are using others' money. Right. So that's the idea here. So again, it should be optimum. So we cannot say higher the better or the lower the better. So you need to maintain an optimum level. Right. So the next one is time interest earned. It's basically EBIT is basically earning before interest and tax. That is basically operating profit. Don't get offended by these words. It's basically operating profit. So you get the gross profit and you deduct all the operating expenses like, selling expenses, administrative expenses, and all the other depreciations. Then you can arrive at this figure, EBIT, earning before interest and tax. Another similar word is operating profit. So you divide it by interest. So what is the answer you get is actually, so your denominator is interest, and your numerator, it is basically EBIT. So it's what you get is how many times your profit is, I mean, how many times your profit when you compare it to your interest, right? So if your answer is 5, your operating profit is 5 times bigger than interest. That's the idea. So this ratio is mostly calculated by banks, like, people who provide loan to others. So they are very interested about this because whether the organization has the capability to pay the interest, they want to check it. So that's why this is very important for us as well. When you are going for a loan, if you want to go for like debt security, if you want to raise debt capital, you really need to look at this as well. Are we capable of paying the interest? Are we capable? Are we really like, struggling, or are we really, we do not have any issue in paying it? So that understanding we can get by looking at this ratio, by calculating this. So EBIT divided by interest. Okay, so that's debt. So equity we discussed, activity we discussed, debt we discussed, profitability discussed, and the market also. This is B. Another one that we can discuss. Under market, there are several ratios we can discuss. We can discuss about PE ratio. We can discuss about dividend payout ratios. And then we can even discuss about market price as well. Market price. But here I am only going to discuss about PE because this is again such an important ratio. Even all the organizations publish their PE in their annual reports as well, same as EPS, right? So PE is basically you divide market price per share. Like, when you issue your shares, there's a market price. The price is determined by the Colombo Stock Exchange. When you open up the market for a particular day, depending on the turnover, they will decide the price. There's a separate mechanism that I am not going to explain it here, but it's basically the market mechanism. It depends on the selling and purchase orders put into the Colombo Stock Exchange. Like we have something called automated trading system. So from terminals, people put their purchasing orders and selling orders for particular shares. So based on those prices, the system determine the market price per day. There is a opening price, there's a closing price. Mostly people are looking at those closing prices. So you divide that by earning per share. The earning per share is basically EPS. We discuss about it. What is EPS? So you divide net profit. If you do not have like, preferred stock, you divide net profit by number of shares that you have issued. That is EPS. So you have market price upfront. So normally this is known as a multiplier because you get like, when you are having a big big number for that. If the PE value is higher, that means it's always good because your market price is going to be multiply that number. So that's the case. So if your PE is 4, let's say your earning per share, when you are increasing your earning per share, your market price is going to increase 4 times than that. Your market price is going to increase four times than that. So when you are having a higher PE, it is always better because it works as a multiplier. You can multiply your PE by your EPS to arrive at the market price. So when you are having a higher PE value, when you are making, let's say you have a 10 P, you have 10 as the answer for this PE, your market, then your earning per share is like, let's say again 20. So 10 into 20 would be like 200. So it would be your market price. So let's say your PE is 10 and your EPS is now like 25. So then your market price would be 250. So that you can't like compare like that. So there is something called benchmark PE for the industry. So you can use that benchmark PE, that means similar industry within the similar competitors. When you calculate that benchmark, it is basically the average amount of PE within the organizations of those within that same industry. So when you multiply that PE with your earning per share, you are going to arrive at your market price. So people are always keen about these PE ratios because it gives you a good indication, because you can see like EPS is basically something coming from your organization, like that is basically net profit divided by number of shares. Market price is basically something determined at the market. So what we do, we take that piece of information and combine that with the EPS, and we create something called PE ratio, price earning ratio. Right. So having said that, I think we have gone through all these ratios that we are supposed to discuss. As I mentioned, there are a lot of other ratios. Sometimes you might come across in future, or maybe you might know at this moment, but we are not going to discuss them. Given the time constraint we have, we don't have much of time to discuss anyway. So we only have 6 hours to discuss on these matters. But we will, I think now the time is like, around 8:58. So we are supposed to stop the class at 9. But we can spend few more minutes, and if you have any clarifications, anything to ask, I think we can have that time at the right now. So technically I'm going to stop the session at this moment. So when we meet at the next day, we will straight away go for the calculations. Like we will do some of the examples. We will go through some of the like statements, and we'll try to calculate these examples, and then we will try to amalgamate all these ratios together and have a snapshot of it, have a big picture on the organization, and we will try to find out information, try to find out whether the organization is good or bad, some sort of a evaluation, right? So with that, I really would like to stop the class, but we can have this time if you have any questions to ask. Obviously, about the assignment, I will be uploading your project basically for your LMS. So it is basically again depending on this same thing that we discussed. So you have to go to your Colombo Stock Exchange website. Anybody can go there. You can download 2-3 annual reports, then you can calculate these ratios. So that would be your assignment. So I will upload the assignment question into your LMS. Probably you can go through it. So I'll be asking you to do both of those analysis. I will be asking you to compare organization 3 to 5 organization within the same industry, and again compare the organization with its own past performances. So there will be, you have to do cross-sectional as well as time series analysis. So it's nothing big, it's really difficult. It's not that difficult. You just go to Columbus Stock Exchange website, you download several documents like several annual reports. Then you open up your laptop and go for Excel. Open up a Excel sheet. You input this data and you then use these ratios. I will be sharing these ratios anyway, so you can go through them. So all you have to do is just do the calculation and write a report on those things, interpret them and write a report. That's it. So I'll be anyway uploading the assignment question probably by next week. I think that's it from my end. So if you have anything else to discuss, or maybe you need to discuss some subject matters, I think we can do it at the moment. If you do not have anything, we can stop the class.
Hello, sir. Good afternoon.
Yeah, of course. Good.
Actually, we are in the course with the multiple discipline. I think we have engineering division and some. I think we
Yeah,
have medical division also.
of
So,
course.
there is any supportive for the further reading or any easy documents to get it for the actually the for the accounts we don't have the basic knowledge, the 100%.
You're asking like, how to, you mean to learn accounting, or you want to understand these concepts?
Yeah, to understand the concept deeply.
Yeah, so what we can do is like, we can upload some open source materials so that you can go through them and understand them. Or in case if you are having trouble in understanding these concepts, or you can always contact us. So I think we all have shared our email addresses and contact details in our LMS. So always you can shoot an email and ask anything you want, like connected to the whatever the things that we discuss. We are more than happy to explain it to you. So somehow what we can do is we can recommend some of the books, and we can mostly upload some of the materials so that you can go through them and have understanding about what these things means. But what I wanted to tell you, like, don't worry about this particular assignment. We know that this the batch that we are having here is not accounting special. Sometimes they might not have even proper education when it comes to these areas. But still, what we want is actually have some sort of understanding about what is going on, because anyway, even though whether we like it or not, all these things are part of our life. So we have to some sort of understanding of it. Have to have some sort of understanding. So that's the idea. So how you are going to do that assignment, I will definitely explain in detail in the next day when we meet, because I don't have any assignment to explain to you, because we have not yet drafted any assignments. So once we draft it and uploaded it to you, we will discuss about it. So how you are going to attempt into that. So, and again, don't worry about it. I think this particular subject you guys do not have any examination, right? Am I right? I think so. This is a
Yes, sir.
yeah, this is just a preliminary subject that you have to go through. This is just there is just one assignment, a mini project that you have to do. That's it. So nothing to worry about. So we are really uh, keen about you understanding these ratios. Like it's like these are basically part of our financial literacy. So how you understand these ratios, how you understand how you are, whether you are able to read these statements, whether you are able to read these between lines, between numbers. Very important as a person who is really want to use the vote. So that is very important area. Most of us actually we don't use that numbers when we are doing the vote. So it is basically part of the financial literacy, whether we study it or not, whether we like it or not, it is basically part and parcel of our day-to-day life. Like it's there. So it is beneficial for us to have some understanding about these matters, so that we can read them, at least we can interpret them. So that is, I think, our objective in this, give some sort of a, background for you to grow if you have not gone through these area. I know some of you, I think you have mastered those areas. There are people who have actually working on these areas. Sometimes there might be professionals also in this batch, but still there are other people who have not, have chance to go through these disciplines. So that's the idea. So in my answer for the question that you raised is, we will upload some of the materials so that you can go through, but still, if you have any problem in understanding these concepts, you can easily contact us, myself or Mr. Asanka. So whenever you want, you can shoot us a mail. We are more than happy to share our whatever the experience or the knowledge we have at the moment. So anything else? Right. So if you do not have anything, I think we can stop the class. I hope you at least maybe got 2-3 points out of the discussion. So then I would be more than happy. And once again, thank you very much for being with me for, we were here for 3 hours. So once again, I'm really sorry for the delay because I had to face that problem. There was a power cut going on in our area. It's not a power cut, it's an emergency one, I guess. So once again, thank you very much and have a good night. Thank you.
Good night, sir.
Thank you, sir. Good night.
Good night. Sir. Thank you.